Welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Marko Dimitrivejic. He has more than 35 years of investing experience and has founded and managed 2 investment management companies with over $3 billion in assets. Today we're going to be discussing his book, Frontier Investor: How to Prosper in the Next Emerging Markets. Marko is a pioneer in conducting on-the-ground due diligence in foreign markets. Let's ask him 5 good questions. All right, welcome back to the show, everybody. My guest today is Marko Dimitrivejic, author of Frontier Investor. Hey, Marko, thanks for taking the time to be with us today.
Thank you very much.
So let's jump right in. And question number 1, can you give us a feel for how bad the home country bias is in most investors' portfolios? And why do you think it exists that way?
That's a very interesting question. There are a couple of reasons. First of all is people tend to be comfortable with what they know. And so there is a bias to invest in companies that you've heard of, products that you're familiar with. And that tends to be one of the reasons. The second reason I would say is also it's easier. It's typically easier to buy shares in your home market. And so that would be the second reason for the home bias. The third reason I can think of is currency. Often when you invest outside of your home country, you have to invest in a foreign currency. And so it seems riskier, and in a way it is, because you're making basically 2 investment decisions. One is to buy or to short a particular stock, and the second is to buy or to short a particular currency. So there's almost 2 investment decisions that are made. And so because of that, I would say that would apply to individuals. For institutions, sometimes you have rules, regulations, or even laws that mandate how much you have to have in your home country. And so that would be a further reason why investors tend to have a home bias. And it also creates an opportunity, because that means that less researched countries where the domestic investors are small or weak can present excellent investment opportunities, such as in frontier markets. So that's where I see the home bias coming from, and it's diminishing. Portfolios are becoming more global, and certainly institutional investors now almost always have a portion of their portfolios invested outside of the home country. But there again, you tend to have some bias towards things that are more familiar. So for Americans, it will be Western Europe. It might be a little bit in Japan. And after that, in the larger emerging markets, the BRICS, for example. For a European, it will be the reverse. A European will be very comfortable investing in UK, and then in the US, and after that in Asia. So it really depends, where your home is, and that will have an influence on what your portfolio looks like. Again, the smaller markets, the less researched markets, the less traded markets will tend to have less traffic and less foreign investors.
And more inefficiencies that a thoughtful investor could take advantage of.
Typically, yes.
So question number 2, and this is a few questions sort of bundled together into execution of investing in foreign markets, or I should say frontier markets. Aside from just stamping your passport a bunch of times and gaining boots on the ground, what are some ways that individuals potentially could do research on frontier markets, especially if maybe you have a little bit of bias or distrust of what the media may portray about a particular country, knowing that if it bleeds, it leads mentality, it's always going to be skewed a little towards the negative.
Sure. There are many ways to invest in frontier markets, and we have a whole chapter in the book that talks about it. I think for the individual investor, first of all, you have to make a choice of whether you invest in frontier markets as a group or if you decide to invest individually. Individually, you have many different ways to do it. The most cumbersome, but the most interesting way is to go at the company level and invest in the different frontier markets themselves. That's where you'll have probably the biggest opportunity. That said, you often see one frontier market doing very well, and in that case, most of the stocks in that country will move as a group. And so by using ETFs, an individual can access many frontier markets. There are ETFs now for countries like Nigeria, like Saudi Arabia, the Philippines, Colombia. There's a whole slew of ETFs. And the beauty of the ETF is it's simple and it's also cost effective. The costs are somewhere between 50 basis points to 90 basis points of management fees a year. So it's a lot less than some actively managed funds, for example. And it gives you good granularity if you have a strong view on Vietnam, for example, and you want to play Vietnam for the next 5 years. You buy the Vietnam ETF. You pay very small brokerage commissions if you use a discount broker, and you have very reasonable management fees. So I think that's a very good way. And then you also have opportunities to buy some frontier companies or some companies that have heavy frontier exposure through ADRs or GDRs. And so that's another avenue for individual investors or even institutions to access frontier markets.
And now, how about hedging currency risk? How do you think about that? Most of the studies that I've seen show that it tends to wash out in the long run, and that oftentimes the expense of doing the hedging is almost not worth it. Of course, then there'll be times where you'll just get pummeled by a currency, and it'll kind of ruin your whole investment thesis. So, how do you deal with that, Tiger?
I think there are two things. I think one of our theses, and again, there's a lot of data on that in the book, is that that the growth of frontier markets and the growth of companies in frontier markets, the dollar growth of earnings of companies in frontier markets, is what makes the case very compelling. So if you can buy growth at a reasonable valuation, and you latch on the sort of growth train that can last many years and in some cases decades, as we saw it with what are now some of the mainstream emerging markets, but that were also frontier markets 10 or 15 years ago. Think of a country like Indonesia, for example. If you can latch on that growth, then really you have two things going. One is the earnings growth, and the second is typically you will have a revaluation of those currencies. So over time, so those currencies that are inexpensive to start with will appreciate. And so I would say for a long-term investor, you don't need to hedge the currency. First of all, it's going to be expensive over time. Right. And if you have this long-term view of a particular country or a particular region doing well over time, you might well be rewarded actually by an appreciating currency. And again, we've seen that in many of what are now mainstream emerging markets. Their currency have appreciated over time because they were very, very inexpensive to start with.
Yeah, and I think there's maybe also something to be said for the demographics factor and the amount of debt that often gets piled on late in a demographic cycle, where the developed countries right now, they're kind of in a race to the bottom of printing and weakening their currencies against each other. And it seems like maybe the frontier markets just by default would start to appreciate because they're not as readily printing, hopefully. So you have that going for you potentially.
Yes, with I think a caveat is that we've had such an extended period of very low rates, zero rates, even negative rates in some of the larger developed markets, that I could see certainly in the next 2 years, the dollar and even the euro potentially strengthening, because in a way they're starting now from such a low base, and it's hard to see rates going down any further in the developed markets. So that dynamic may impact, again, as a long-term investor, 1 or 2 years is not a long time, and I would tend to agree with you. But there is a potential short-term danger to frontier or even emerging market currencies.
Yeah. So question number 3, what investment style pairs best with a frontier market approach? So, you could picture maybe a GARP approach would be because there's so much growth, or even maybe, a deep value approach because there's so much inefficiencies and you could get a bunch of assets for really cheap. In your experience, what's kind of been the best way to take advantage if as far as how you would slice the value and assess it?
Yeah. Well, if simplistically we look at value and growth, what's interesting in frontier markets is often you find both. If we define value as an inexpensive valuation, a single-digit PE type, very simple yardstick, you can often find that in frontier markets. Now, the deep value, I would say, is interesting, is always an interesting style, but the thesis in the book, and a lot of data supports it, is really that you want to catch that wave. You want to catch that long-term wave of growth. And because so many of the frontier markets are starting from a low base, I believe that it's very likely that you'll see the same phenomena that you saw in what are now the mainstream emerging markets, where people go from having almost no disposable income to being able to afford a cell phone and a washing machine and a refrigerator,
a car.
And then going on to a motorcycle, eventually buying a car, and clearly after that buying a house. And that pattern of growth is really what you want to catch. And I think because you're looking at it as a long-term investment, the really attractive opportunity is to find the champions, the local champions that will ride that wave of earnings, income growth in those countries. And so there may not necessarily be the cheapest stocks, and sometimes some of them are even, pricey, in the teens or high teens. But if you can catch something that's going to grow, for the next 10 years at 15 to 20%, then that extra premium that you're paying might be worth it. And often the cheaper stocks are either resources stocks or companies that are government controlled. Mm-hmm. And again, looking at a country like China, for example, the strategy of buying the cheapest stocks was not the right one. You had a lot of coal mines, you had a lot of iron ore or steel makers that were cheap government-type enterprises. And really what made you a lot of money was to find the Baidus and, the companies with a very deep moat around them that were able to preserve market leadership and were able to grow their earnings at, very high rates for very long periods of time.
So it sounds like maybe a PEG ratio might be a good first cut, just to see what you can find for relatively cheap but growing.
Yes, I think again, the opportunity and there are a lot of statistics on that is catch that growth wave.
Yeah. So question number 4, what's the story of the evolution of Singapore as sort of an archetype of the frontier market? Starting from basically a backwater swamp in Asia, and then growing to what it is now. And how does that really illustrate how successful frontier investing can be?
Well, you're really taking there the base case scenario. I mean, Singapore is not only a frontier markets success story. I think it's a success story. Period.
Yeah, human success story.
Absolutely, and really, it's a lot of things going right. But by far, the main factor was a very enlightened leadership that focused from the outset on making the country very competitive by not only implementing rule of law, by stamping out corruption, by making the process of doing business as efficient as possible, and by heavily investing in education and really focusing on creating a very educated, very competitive workforce. And that takes time. And so, the easy path for politicians is not to do any of the above that Singapore did. And so you needed very strong willpower and a perfect implementation. Also, it helped that Singapore was in a region that was growing itself quite fast. And so you had almost a perfect combination. But yeah, Singapore was poorer than Jamaica, was poorer than Cuba at the time of its independence in the 60s. And through its policies in 2 generations, it became a first world country. Now, how do you replicate that? Well, a lot of people have studied that, and some countries have tried to take some elements of it. But it's hard, and that said, you don't need to be Singapore to have a successful investment story. There are a lot of countries that will only get 50% maybe of what Singapore did right, and still do very, very well for themselves, for their citizens, and for companies incorporated in those countries. So I think you don't need to be Singapore, but clearly there are a lot of very good elements to copy in that story.
So who's the closest candidate right now of being potentially the next Singapore?
Well, Panama is quite intriguing because Panama is in a way a little bit of a regional hub, just like Singapore was. It has a pretty solid economic policy. I would say probably the education is not at the level in terms of what they're doing to what Singapore did. So that's probably the weakest part in terms of analogy. But it has also some advantages that Singapore didn't have. One of them being the canal, which creates a very steady flow of income for the government. So net, that's probably a country that could follow in Singapore's path.
Yeah, interesting. I can see the similarities from a kind of geography standpoint. Almost if you think about like Jared Diamond's Guns, Germs, and Steel, about how much we underappreciate just simple geography, the impact that it can have.
Absolutely.
So question number 5, economic progress has typically followed this pattern where the farmer becomes a factory worker and then eventually becomes a knowledge or service worker. And that's kind of how countries have gotten onto the economic growth ladder. What's with the possible robot revolution where we have artificial intelligence and robots that are really displacing a lot of potential human labor? Is it possible that some of these frontier countries won't even be able to get onto sort of the ladder to start climbing because of being displaced by robots? What do you think about that?
I think it's a powerful argument. Where I think we'll see first the heavy implementation of robots. However, will be in countries or regions where the incomes are high, and so where substituting the robot for a worker that makes $20 an hour is very cost effective. Eventually, if the cost of robots really come down, and there are no reasons to believe that they won't, It will also mean, possibly displacing a worker that makes $2 an hour. Will it displace the worker that makes $2 a day? Who knows?
Yeah, that's pretty far down.
it's pretty far down. So that's clearly on the manufacturing side. I think that's something that is out there, and we see it already in a way now that China is one of the heaviest adopters of robots, even though the labor costs in China are still quite lower than in the United States or in Western Europe. So we have to be also cognizant of the fact that, maybe those factories that will employ a lot of robots may end up being in some frontier markets, because whatever non-automated task you have will still be done by humans. And again, it's cheaper if the human makes $2 a day rather than $20 an hour. And so even the supervision of the robots, may end up being done by people that make a lot less in China or in Bangladesh, for that matter, than they are making in California or France. So yes, I think, it will have an impact on manufacturing on a global scale. There is no doubt about that. That said, a lot of the success stories in frontier markets will be about, local brands and local consumption and even local services. And so that, again, to the extent an insurance company gets automated, yes, it will have an impact on employment. But I think it's a really a global question, and not only for investors, but from a policy standpoint, it's going to create huge disruptions across, developed, emerging, or frontier markets.
Yeah, I mean, where's the purchasing power come from for the individual person if they don't have a job really that they're able to contribute with?
Absolutely.
So, bonus question we always ask, and that's for a book recommendation. What do you have for us today?
There is an author that I like very much. His name is Dan Ariely, and he does a lot of research on psychology, and it's psychology that can apply to investing because he highlights a lot of irrational biases that humans have. But it's also very interesting because it applies to a lot of other realms of humanity. So he has a series of books on honesty and irrationality. I think there's 4 or 5 of them. And I've always enjoyed reading them and giving them to friends to read.
Yeah, it's almost sort of like the missing manual for your brain in a lot of ways to help you figure out, okay, why do I make the same bad decision over and over again?
That's right. And it goes counter to a lot of thinking and theories about how rational people are, that humans make rational choices, that you have this Homo economicus, that's a proverbial person that you find in economics textbooks, and that's supposed to also always make those rational choices. And many experiences that this author and his team have done, and many others, show that it's not. That there's a lot of biases that influence how we make decisions.
Yeah, exactly. Well, Marko, it was a real pleasure hearing from you, and I really enjoyed Frontier Markets, or Frontier Investor, and learning more about frontier markets. And thank you for writing it.
Okay, I'm glad you enjoyed it.
All right.
Thank you.
Thanks for watching. I hope you enjoyed this interview. If you'd like to support this author and purchase their book, click here. If you'd like to become a subscriber to 5GQ, click here. And I included a couple other interviews that you might appreciate right here. Thanks. Happy reading.